Hey, if you haven't watched already our previous video on what is the sequence of return risk, you want to watch that first in order to make sense of the following videos, which talk about how to reduce the sequence of return risk. So in the comments of this video, you'll find a link to the previous video on sequence of return risk. This video, what we're going to do is we're going to start our discussion on what are the different ways and what are the different vehicles, what are the tools out there that can be used in order to reduce the sequence of return risk. So this video, we're going to focus on reducing what's called the standard deviation of your investments or of your investment portfolio. So before we launch too much into that, I'm going to go to my whiteboard here. And what we want to do is we want to talk about what standard deviation is. What is risk as it relates to a portfolio? So if you look at the standard bell curve of how returns come in and kind of the sequence of returns, what kind of a range of returns could we possibly expect year by year by year from an investment portfolio? Let's say as it might deviate from the average. So let's say the middle of the road's the average. Let's say it's 7%. And then one standard deviation, you might feel like you've gone back to statistics class here. Let's say that the average is 7% and that the standard deviation, I'll use SD for that, is 10%. All right. So what does that mean? That means that if the average is 7, one standard deviation to the positive, going from 7 to 17%, and one standard deviation to the negative, which would be 7% minus 10, going to negative 3. This range, negative 3 to positive 17%, that will happen in terms of standard deviation being 10%. That'll happen about 2/3, historically speaking, 2/3 of the years in your investment return, the dispersion of it. 3-year averages, in other words, 3-year averages can range between negative 3 all the way to 17% if our average is 7 and our standard deviation is 10. So what happens if we lower our standard deviation? What happens is we compress the highs and we compress the lows so that we have lower highs and lower lows, or higher lows, however you want to look at it. In other words, the range of returns gets compressed so that the lows aren't as low and the highs aren't as high. So a standard deviation, let's say, for example, of half that, 5%, would mean that our range of returns 2/3 of the time would be 12, and then 7 minus 5 would be the 2. So in other words, these are both positive numbers. Compressing that so that the range of returns 2/3 of the time was between 2% and 12% versus negative 3 and positive 17. So in other words, this whole standard deviation number, which describes the range of the returns, is what we're trying to reduce. We're trying to compress that range of returns so that ultimately we don't have these big wide ranges, big highs, big lows, and that's what really makes the sequence of return a portfolio really vulnerable, is those big ranges. If you look at the very first video we did on what is the sequence of return, what is the sequence of risk return, you'll see that the range of returns that were used in the example were very extreme. Negative 37%, positive 20%. That was actually the actual returns of the S&P 500 over a particular period of time. And the standard deviation of the S&P 500 is actually greater than 10. So I did a little example using my financial software. What we did is we created a sample portfolio, and the sample portfolio was 60% stocks, 40% bonds, and we basically said we had $500,000 and we needed $25,000 a year. And we kind of plugged in a particular set of, let's take a look at this, the standard deviation. This would be under our allocations. Our standard deviation, so we had an average return of 7 and a standard deviation of about 9.67. And so we basically ran the numbers and said, well, how likely is it that this $500,000 portfolio will still have money at the end of the plan when they're still age 95? And there was a 77% chance, or 77% of all of the runs and stress tests that we did still ended up with money. Well, what we did is we went back and we said, well, what if we didn't change the rate of return at all? The average rate of return, we're going to keep it at 7%. What would happen if we adjusted the actual volatility or the standard deviation? And we did that in a couple different ways. We said, what if the standard deviation is twice the amount of the average return? So in other words, if the average return is 7 and the standard deviation is 14, what's the outcome? Well, there's only 66% chance of the money lasting. What if the standard deviation is 1.5 times the average return? Well, it's 70% chance. What we did is we kept reducing the standard deviation. We didn't reduce the return at all, stayed at 7%, but we reduced the standard deviation down. Well, what happens when the standard deviation equals the average return? Well, then the likelihood of success goes up to 80%. What if the standard deviation is only 3/4 the average return? Well, it goes up to 87%. And then finally, we tested what if the standard deviation is only half of the average return. And then we saw here that the actual possibility of money lasting in that case, same amount of distributions, went up to 96%. So this is just math and science. It's saying let's not try to increase the return at all, but let's try to decrease, let's try to compress the range of the returns that we're receiving. Take down the high highs, remove the low lows, so that the actual range of the returns that we're experiencing is much, much less. And so that's just math and science talking. As you can reduce your standard deviation of your investments and of your portfolio overall, you are going to reduce the sequence of return risk.